Now, our theme for the conference relates to challenges after the pandemic, and I will end my remarks with my reading of some of the ongoing challenges. But as you pointed out in your kind introduction, the focus of my remarks will be on the central bank policies we observed last year during the pandemic, which I consider a case of policy success, and I hope would serve as a guide for policies going forward. Fed, BOJ, and other central banks in advanced economies activated of their balance sheets in a way that was better than what had been done in prior experiences. Now let me share some slides. I hope you can see my slides. Let me start by simply stating what I consider to be the key lesson from this. 2020 was the year the power of central bank balance sheet was unleashed in advanced economies. Between March and June 2020, the Federal Reserve expanded its balance sheet by $3 trillion in just 3 months. Just to put this in perspective, it took the Federal Reserve 100 years, the first 100 years of its history from 1913 to 2013, to have a similar money printing, if you wish, or expansion of its balance sheet. And of course, the Fed was not alone in doing this. The Bank of Japan, the European central banks, and really most central banks in advanced economies, and even some central banks in emerging market economies for the first time, activated the power of their balance sheets in an unprecedented fashion. Now, if I focus on the Fed, the ECB, and the BOJ, out of thin air, as central banks can do when money is managed properly, generated fiscal resources in the range of 15 to 25% of GDP. And this was an incredible show of force, engineered to provide monetary easing and cushion the economic blow from the pandemic, to prevent the meltdown of financial markets and institutions. And let me note, we didn't have as many financial crisis episodes as we could have had last year if it were not for this activation of the power of the balance sheet. And the third point I want to focus on later on is that this activation of balance sheets facilitated also a fiscal expansion while improving government debt dynamics, the thing that we discovered, the thing that was discussed somewhat yesterday. Now, ordinarily, such unprecedented money printing would be cause for alarm. We all know that when misused, the power of central bank balance sheets can wreak havoc on the economy. As textbook responses to a crisis suggest simply cutting interest rates as much as necessary as the first line of defense. But in the current environment, with interest rates having been so low, and as I will remind you in a few minutes, with no room to cut interest rates at the beginning of the pandemic, it was imperative that central banks used the power of their balance sheet as the policy response. And this is what we've seen last year. Now, previous encounters with a zero lower bound shaped the policy response we observed last year. We have had three experiences with a zero lower bound in advanced economies in our lifetime. Before that, we have to go back to the Great Depression to see anything similar to that. And to understand the rationale behind the massive balance sheet expansions observed last year and why they were warranted, it is useful to briefly revisit these two earlier encounters with the zero lower bound in February 1999 and in October 2008, and then see what the environment was in those times, what the lessons that were drawn from those experiences were that were applied better in this episode. Now, the first episode was in 1999. It only affected the Bank of Japan. But I want you to see just from this diagram, Bank of Japan, after the Asian financial crisis, needed to cut policy rates and ease, much like other economies had to, and it only had 50 basis points to ease policy, even though at the time macroeconomic conditions in Japan called for greater easing than would have been necessary in Europe or in the United States. The BOJ did not have enough room to engineer that easing, and this was the beginning of what ended up being a period of mild deflation in Japan because of the questions about how this should be handled. What was not fully appreciated at the time, and it took a couple of decades to understand the extent that it was happening, is that equilibrium real interest rates had been declining around the world, and substantial quantitative easing would be necessary to defend against deflation. Unfortunately, the economics profession, academia, did not help. As is well known, the highly stylized models of the macroeconomy that were popular at the time assumed that nothing other than the central bank short-term interest rate matters for the monetary policy transmission. And this ended up misleading some policymakers into doubting the power of central bank balance sheets at the zero lower bound. Now you can see in this chart also the second episode associated with the global financial crisis. And here you can see all three central banks quickly reached their lower bound. The case of the ECB, not right away. It took longer, but I will not go into the details. And all three central banks actually activated their balance sheets much more forcefully than in the past. In terms of the level of central banks, if you track the size in $1 trillion, trillion euro, 100 trillion yen over the past 20 years, it appears to be a similar expansion in order of magnitude. When plotted in terms of as a ratio of GDP, you can actually observe that of the three, the Fed expanded the least compared to the others. And yet, one of the interesting observations of the past decade is that the Fed was the only central bank that managed to expand its balance sheet sufficiently early and sufficiently vigorously, really doing it right away after the Lehman collapse in 2008, that by the end of the 2010s, it managed to raise inflation to almost 2% and almost achieve its price stability goals. Now, one of the issues here is that multiplicative uncertainty that is associated with balance sheet policies that are we have much less experience with them than with interest rate policies, argues for a more cautious and gradualist approach to balance sheet expansion. But of course, this uncertainty and hesitation that it leads can also lead to policy errors and associated occasional policy reversals. Now, problem is that at the end of the 2010s, if we look at policies as of 2019, despite these massive balance sheet expansions, inflation was lower than policy makers in all three central banks would have preferred. For the Fed, maybe just a couple of tenths. For the ECB, where inflation was very well anchored around close to 2% in accordance with its mandate before the global financial crisis, we have had almost a decade of lowflation. And in the case of Japan, we still did not have the increase in inflation that the BOJ was aiming for in the second part of the decade. And that meant that there was effectively no room to ease policy at the beginning the pandemic. And you can actually see how little room there was by simply having a look at the 2-year OIS rate in the 3 currencies in early last year, which I show in this slide. As you can see, as we get into March, and I have 2 lines here, 3rd March, 23rd March, because I will discuss a few episodes associated with the events in between those 2 days. The Fed had very little policy room and quickly exhausted it. In the case of the BOJ and the ECB, nothing at all in terms of policy rates. So let me focus on what happened in those critical weeks in March for a few minutes. I have a few dates on these slides. March 3rd was the first policy easing we have seen in the 3 central banks cutting interest rates. March 12th, it was an unscheduled meeting. March 12th, we have some easing measures by the ECB at their regularly scheduled meetings. But the most impressive meeting was actually on 15 March 2020, Sunday afternoon in Washington, Sunday evening in Europe, and actually Monday morning of March 16 in Tokyo. And there we saw a coordinated swap line activation. Fed, ECB, BOJ, and some other central banks took place in that. And actually 2 additional massive programs that were being announced. First of all, the case of the BOJ moved earlier than its normal time by 2 days, its ordinary meeting, and announced expanded purchases of government debt, ETFs, J rates, and quite important corporate financing support liquidity provisions. In the case of the Fed, this is when the Fed returned to the zero lower bound, expanded purchases of government debt. Now we had an extraordinary meeting in the case of the ECB on the 18th of March. I will return to this meeting later on. But what I want to show you is that, as a matter of fact, this massive policy response that we had for a couple of weeks here did not stabilize markets. And it was not until March 23rd that we managed to see a turning of the tide in financial markets. So all of these actions, including the cutting interest rates, the liquidity easings, in the case of the ECB, the expansion of the purchases, did not prove sufficient. This is quite impressive to actually see by comparing stock market indexes in the 3 economies, how coordinated, if you wish, the reaction of markets was to the reaction of central banks to the pandemic. And particularly from this chart, market sentiment only turned on 23rd of March. Stock prices rallied and corporate bond spreads tightened notably following a series of new measures announced by the Fed that day that underscored the Fed's resolve to serve as a backstop not only to government securities, as it had already been doing, but also to private credit. Using its authority under Section 13.3 of the Federal Reserve Act, which can be utilized under unusual and exigent circumstances, the Fed established a primary market corporate credit facility for new bond and loan issuance, and the secondary market corporate credit facility to provide liquidity for outstanding corporate bonds. And the fact that the Fed announced that it was ready to purchase newly issued corporate debt and support trading in previously issued debt in private markets, which was a very unusual position for the Fed to take, is what actually turned the markets. And I'm going to highlight that, in my view, the most important aspect of these programs was eligibility, was the willingness, in this case of the Federal Reserve, to do something that the Bank of Japan has already shown how effective it could do somewhat earlier, to announce that it was ready to backstop corporate debt, even if it were subsequently downgraded. The terminology that is used for this is fallen angels, which was a clarification that was issued on March 9. So it's important to understand here one of the lessons of this that was confirmed with the decisive actions of central banks we've seen last year, that a central bank can short-circuit adverse market reactions by using its balance sheet as a potential backstop. Committing to do so promptly, which is what we saw in March of last year, can protect against self-fulfilling equilibria with minimal balance sheet expansion. We did have a massive balance sheet expansion, but in terms of the market stabilization effect in private markets, it wasn't really that big. And if you actually look at the swap lines, which were incredibly effective for stabilizing global exchange rate conditions, at the end of the day, they were negligible in terms of what needed to be activated. Now, the BOJ had already experience with equities and J rates and corporate liquidity facilities. The Fed had some experience from the global financial crisis with Section 13.3 facilities, but that experience was very limited, and it was expanding the use of those facilities that was so helpful last year. And we also mentioned that this issue of who is eligible to get support from the bank, from the central bank balance sheet in a period of crisis is a crucial question that was also handled much better by the ECB last year than in previous episodes. Now, as is well known, the ECB has been relying on credit rating agencies for implementing its monetary policies. This is a practice that is not in line with what other central banks are doing. The ECB is unique in this, and this has created some problems in the euro area. We've seen this with episodes of turmoil over the past 10 years in government bond markets. And we've actually seen an episode like that last year as well. So this chart plots the spread of 2-year government debt yields over OIS rate. Now, if monetary policy is implemented correctly and smoothly, this spread should be minimal, even during a crisis. And of course, in the case of Europe, over the past 10 years, these spreads have not been minimal at all, and we've had episodes of crisis every few years, really, since 2010. Last year was no different, and we've seen that we had a very intense episode that could have evolved into a crisis as serious as what we've seen in 2010, 2012 in the euro area if it were not handled. The key here was eligibility, and the eligibility of government debt for the ECB's monetary policy operations, which again was in doubt because of the ECB's reliance on credit ratings under ordinary circumstances. As I mentioned before, the ECB is at its regularly scheduled meeting, but that did not really have the desired effects because the ECB failed to address this specific fragility. And the ECB subsequently took 2 important decisions that I showed here on 18 March and on 22nd of April that address this issue. The first was the pandemic emergency purchase program on 18 March. The ECB announced that it stood ready to make purchases of assets, including government debt, in order to ensure that its monetary policy transmission would be smooth everywhere in the euro area. And you can see that this did have a stabilizing effect for a while, but not long. And the reason for that is that there were still questions remaining. What if the ECB is simply following credit ratings that would reflect downgrades of some governments actually ended up denying eligibility of government debt for some of the governments in the euro area, which would have once again returned us to the crisis. Then to address this issue, the ECB took the most important decision of the crisis on April 22nd. It effectively suspended its own internal operating procedures and suspended the reliance on credit rating agencies for determining the eligibility of government debt, as well as other assets, but those are much less important for its monetary policy operations. What we have seen is that by expanding the eligibility boundaries, the three central banks managed to stabilize markets very quickly and rapidly. Now, let me turn to another element, which is the fiscal monetary interactions. The second element that I think was handled much better last year than in the past. And of course, as a response to as a reaction to the pandemic, we have seen the need for governments to have much larger primary deficits last year, and of course, further increases in government debt ratios that can be quite concerning. And I want to highlight, following up some of the discussion that we had yesterday on debt dynamics, 3 stars that matter for understanding debt dynamics. Now, we've discussed potential output growth and the equilibrium real short-term interest rate yesterday, but as a matter of fact, there is a 3rd star that comes into play. It's not just about the short-term real interest rate and potential output growth. There is another element that matters here quite a bit, and this is what is the term premium on long-term government debt, because this is what is going to be affecting the cost of refinancing government debt at long-term horizons. And if you look at that, we need to remind ourselves that quantitative easing has a very important, economically important effect on compressing the term premium. This is how it works, and it's an uncertain effect, but it's actually quite important, and we have seen this in empirical studies in a number of major central banks, and I have some estimates here for the Fed, ECB, and BOJ. Now, if you just focus on the Federal Reserve, you can actually see that we have already had a decline in the term premium before the global financial crisis, but then a further decline that can be attributed to quantitative easing since the global financial crisis and last year. And why is this critical to understand? Well, the low equilibrium real interest rate limits interest rate policy easing, and this is what complicates interest rate policy. But at the same time, quantitative easing can partially substitute for interest rate easing by boosting asset prices, by boosting prices of government debt, and by compressing term premia, reduce the cost of refinancing of government debt. Now, this is very important to understand, and I think it was handled much better over the past year than after the global financial crisis. You will recall after the global financial crisis, we had calls for austerity, including by the IMF, as I recall at the time, for a number of years, and then governments. Fiscal expansion was not as vigorous as should have been, which was recognized exposed, and in this case, it was handled better. In addition to the direct monetary policy easing that quantitative easing can provide, quantitative easing can provide indirect easing by facilitating extraordinary fiscal expansion. When the equilibrium real interest rate is low, coordinating fiscal and monetary policy in this fashion is critical for protecting against debt deflation. And I hope that this is one of the lessons that we keep going forward. It's very important to understand that if you put this channel of monetary policy transmission and debt dynamics in a standard, in an otherwise standard economic model, you will also be able to see that excessively debt-averse fiscal policies can be self-defeating. And this is really the basic lessons that I hope we can keep from the crisis. Let me end by pointing that of course this is not the end of the story. we have had a much better handling of the economic challenges last year by active use of the power of central bank balance sheets that we have had in the previous two episodes where central banks face a zero-dollar bound over the past 25 years. In a low interest rate environment, central banks must be ready to activate this power, even though it raises difficult questions. You know, it's more challenging it raises more challenging governance questions. Quantitative easing, balance sheet policies have more pronounced fiscal and distributional consequences. They can attract scrutiny and criticism. So what is the best way to protect central banks from the challenges after we see such an activation? And in my view, the answer is pretty simple. Just follow basic principles of central banking and monetary policy. Stay apolitical, stay true to delivering in a systematic fashion on price stability, avoid engaging in other mandates that may actually tax the central bank. And by doing that, central banks can actually defend effectively their independence, which I fear will otherwise be compromised once the power of their balance sheets has become so evident, something that was not really realized in the past. Let me stop here. Thank you.